Well, the financial crisis, big lesson from the financial crisis for those who are in the investment world is that people occasionally go crazy as a group. And you had the tulip mania, and people are capable. They love the idea of getting rich. Humans are susceptible to wanting to believe that that something that's happened recently is going to continue, and that they're going to get rich based on it. And if they see their neighbor getting rich from doing something, and they think they're smarter than their neighbor, and he happens to be buying single-family homes and borrowing the limit on them and refinancing them as he went along to sustain consumption, and then they see prices continue to rise, so they get this proof back from the market, they get this feedback. Eventually the whole country goes crazy, and it's very hard to resist a craze, and particularly when it's gone on for some time. The 1920s, we had a somewhat similar phenomenon where people discovered common stocks for the first time, really, the American public. And originally it was a sound premise. American businesses are pretty good things to buy, but they're not pretty good things to buy at any price. And houses are pretty good things to buy. In fact, it makes sense for people to buy houses, but one they can afford and with payments they can make. But it doesn't make sense to start paying twice replacement value and borrowing 90-some% of it and lying about your income and all those sort of things that come along. It looks like it makes sense for a while because it does work, and then all of a sudden the music stops. It's a little like Cinderella with the ball, Cinderella with the ball, and she knew at midnight, it was all going to turn to pumpkins and mice. But it was so much fun. The music is good, and the boys look better, and the drinks flow, and you don't want to miss out on it. It's getting better all the time, so you think, I'm going to leave at 3 minutes to 12. But the trouble is there are no clocks on the wall. It doesn't tell you when it's 3 minutes to 12, and everybody else is thinking they're going to leave then. And then the music stops, and everything turns to pumpkins and mice. And investors have to be able to detach themselves from those emotionally and temperamentally from that tendency to go along with crowd behavior. Anytime you buy a stock, if you're going to buy 100 shares of Microsoft at 26, whatever it's selling for, and there are 8 or 9 billion shares out, that means you're going to pay $200 billion for the company. Now, you're only going to buy 100 shares, but I suggest that you get out a yellow pad and you write, I am buying the Microsoft company for $200 billion because. And if you can write a sensible essay on why it doesn't have to be very long, few lines will do. If you can say why it's sensible to buy the company for $200 billion, then you can say why it's sensible to buy 100 shares at 26. And if you can't say that, forget it, because all you're doing is betting on what some hunch somebody has or what somebody said that day on television or something of the sort. You are buying a business when you buy a share of stock, and you have to be right about the business to be right about the stock. And you're not going to be right because people agree with you. You're not going to be right because people disagree with you. You're not going to be right because somebody that's in a prestigious position says that it's the thing to do. You're going to be right if you're right about the business. And that simple little activity will focus you on what you're really doing. When I bought that farm, I said, I am buying a farm in Burt County, Nebraska at $700 an acre because, and I put the because, I think it will produce so many bushels an acre of corn, so many bushels an acre of soybean, and I will need to pay the tenant farmer so much, I need to pay so much in taxes. When I get all through, I will have about $80 an acre coming in, and I'm paying a little less than $700 an acre, and that's fine. That's going to work if I'm right. And the same thing applies to stocks. The same thing applies to buying an apartment house and renting it out. You have to go through that discipline. Inflation is a very cruel tax on people. Inflation is an invisible tax that only one man in a million really understands, and it's a tax on people that have had faith in their currency that the government's issued. The best investment against inflation is to improve your own earning power, your own talents. Very few people maximize their talents, and if you increase your talents, they can't tax it, they can't take it away from you. So if you become more useful in your activities, your profession, doctor, lawyer, whatever it may be, that is the best protection against a currency that might decline at a rapid rate. And the best investment, passive investment, I think, is a good business. If you own an interest in a good business, you're very likely to maintain purchasing power no matter what happens to the currency. But it's interesting, in the United States, what value of the dollar since I was born has declined by 94% to 6 cents. So inflation is a very cruel tax on people who believe in fixed dollars, but things can work out pretty well even during inflationary times. I mean, if somebody told me when I was born, that the dollar bill is going to go to 6 cents, I might have said, let me go back. I'm not interested in emerging into that kind of a world. But actually, it's worked out pretty well, so I have no complaints.